In this video, we're going to talk about proper estate planning. This is focused more for individuals that are in the high net worth range. And what we're finding is a lot of doctors, as they go through their career, they're maybe opening additional practices, they're growing the business. And so when they come close to retirement age or close to a time where they're unfortunately passing away, they actually have gotten to that very high net worth level and are faced with the challenges of estate tax planning. So Matt, can you tell us a little bit more about what are these challenges, what is estate tax, and why should doctors be concerned about it?
Absolutely, Dr. White. So I'm going to just paint the picture here, right? First and foremost, this video really is constructed for business owners and or just very high net worth individuals and doctors. Maybe they've gotten a big inheritance, something like that, right? This video is instructed and conducted for you. Right now, the big picture is that there's something called an estate tax. Right now, that's set at $26 million. So if you and your spouse over $26 million, right, or $13 million solo, okay, then you are considered over the estate tax exemption. Meaning, if I have an asset, if my assets accumulate to $50 million, maybe $40 million is valued in my business, and I have $10 million of real estate, or $8 million of real estate and $2 million in the stock market, right? Something like that. That means that I have, if we take away the $26 million, estate tax, that I have $24 million that is exposed, okay? That exposure of $24 million is subject to a 40% tax upon death. There's no ifs, ands, or buts about that. Now that 40% tax, right, in that scenario would be about $10 million. That $10 million is subject to be paid within 90 days of death.
So that's pretty fast. Now, in that example, if 40 million is in the business and 8 million is in real estate and 2 million cash, where do we get the 10 million to pay the tax?
Well, that's a great question. A lot of the times we'll see selling off shares of businesses. We'll see liquidation of real estate. We'll see liquidation of stocks and mutual funds and investments that individual has built up over time. So if estate planning is not done properly for those high net worth individuals or individuals that are already starting to accumulate wealth that's going to kind of teeter towards that threshold later in life, then there's a really big problem at hand. Now, the good news is that Dr. White and myself specialize in proper estate tax planning or a proper estate tax mitigation strategies through life insurance. So going back to the big picture, if you have $10 million of estate tax to be paid, right? 50 million of assets, 24 exposed, 40% tax brings you to about $10 million, right? And you're in your 50s. Well, Dr. White, what do you think is going to happen by the time you die? You think it's going to stay at a $10 million estate tax, or you think your assets are probably going to go up?
They're probably going to go up.
Probably going to go up.
Especially if you have life insurance as an asset and over 20, 30, 40 years it's accumulating, those policies can generate very, very large cash values at the end. And you may say, well, right now I only have $10 million, but your whole life policy could end up being another 10 million and another 10 million.
Right. Didn't even take into account life insurance, right? So what I'm getting at here is life insurance can be utilized to mitigate estate taxes. Now, again, I am not an estate attorney. Dr. White is not an estate attorney. These conversations are had with estate attorneys and CPAs a lot of times, okay, to ensure that the proper planning is done, right? Goes back to kind of the puzzle piece concept of you need all the players at the table that are kind of that advisory team for you. But I'm going to just simply state how life insurance can be impactful when it comes to mitigating estate taxes. Now, there's no real way to say I'm never going to pay estate taxes. But Dr. White, if I could tell you that you were to only pay $1, $2, maybe $3 million out of pocket today, which is going to protect $15, $20 million of estate tax exposure tomorrow for your family, do you feel like that's a fair trade-off?
Yeah, it sounds like a great trade-off, but then the question becomes, in that scenario, again, 40 million in the business, 8 million in real estate, and 2 million in stocks. How do I actually afford that policy? Because I don't want to liquidate that whole $2 million stock portfolio.
Yeah, no, great question. So from the big picture again, the way that it's done is by utilizing life insurance to be put inside of a trust that is considered outside of the estate. So you have that trust benefit and the proceeds upon death pay out the estate taxes, okay? That's the big picture. That's the general picture of how do we utilize life insurance simply to pay off estate taxes. We account for proper estate planning. We say how much do we want to protect? How much do we want to mitigate? Do we put it inside of a trust? How much does that cost? And how do we, and then therefore that life insurance policy is paying off that estate tax. Well, at least a portion of it, right? Now, to your point, what if I'm working with somebody? What if we're working with somebody that's a business owner, it's tied up into this, they got a lot of real estate, maybe they're worth 100 million, 75 million, 200 million, whatever it is, and a lot of it is not liquid. They're very cash flow poor, right? What we can also look at is something called premium financing. Now, premium financing, as we talked about in one of our other videos, life insurance as an asset is used as a safe bucket, right? It's guaranteed, it's conservative. Premium financing is really for the individuals that value leveraging debt and leveraging other people's money. So consider the example of a $10 million permanent life insurance policy to be put inside of a trust. And that premium, right? Let's say, the individual's 50 years old. That premium could be $500,000 a year, right? For 10 years, right? So we're looking at smaller paying products, right? That could be used for, $500,000 a year. They can't, not that they can't afford it, but they don't have the cash to pay for it. What we can do is we can set up something called a premium finance loan. So we will actually work with banks, and sometimes, and a lot of times, our current clients have those existing relationships with those banks already, and those banks will lend them the premium on the policy. The client will have to post a little bit of collateral in order to, account for the loan. But at the same time, they're only paying the interest on the loan. So you're not paying that $500 out of pocket, or maybe the client's comfortable saying, Matt, I'll pay $100,000 out of pocket. So you're paying 25% and you're mitigating the amount of loan that you're receiving. But again, a lot of times we'll see clients just only pay what's called interest only and pay off that loan interest, right to the bank. And that's what's used to pay the policy premium. They're paying a substantially less portion of what they would be because they're not cash heavy, and they're actually getting the appropriate amount of insurance protection on the policy. It's extremely effective, but it's only for the right clients. But to answer your question, there's unique ways where individuals that might not be cash heavy to utilize to still mitigate their exposure in the appropriate amount of life insurance.
That makes sense. And, to Matt's point, the trust that he's talking about is something that is a really important concept for estate planning. It's used obviously to have life insurance in there as well. And the great thing is that we work with a team of attorneys and CPAs that specialize in those facets of estate planning. So when you come to us, we'll bring that whole team together and make sure that not only are you looking at strategies to mitigate the estate tax, but also other ways where you can look at how to put other things into trust. For example, in my case, I have a collection of wine that's for my daughter when she turns 21. That's in a different type of trust, and that's sitting there as well for her benefit. So there's a lot of interesting things that you can do, and trust is really a central piece of estate planning that ties in very, very well with insurance products, as well as other assets that you can put in there.
Absolutely. And as business owners or high net worth individuals are listening to this right now, maybe we're on the side of your screen, maybe we're minimized, but you're still hearing us. One thing you can Google is called an irrevocable life insurance trust. Those are the types of trusts that Dr. White and I refer to when we're talking about how to put life insurance, and utilize that life insurance to mitigate that estate tax. So if you want something to Google, it's called an irrevocable life insurance trust. Now, Dr. White, when it comes to high net worth planning, what is something, since, let's be candid, we're both doing pretty well. What is something that you see in your end when you think about doctors or general estate planning or anything that they tend to not think about all the time that should be crossing their minds a little bit more and more?
Yeah, so with estate planning, the other part of it is you want to protect the generational wealth that you're building from creditors. And one of the things that irrevocable trust does is it's also a creditor protected trust, meaning that if, God forbid, there's an issue in your practice and you're liable for a malpractice suit, any assets that you've already put into the trust would be protected from that. And that's an important thing for a lot of doctors that they don't always think about because they think of malpractice insurance as being sufficient to cover that. And in some cases it is, but in some cases you may be in a situation that your other assets could be at risk. So for those assets that you want to leave for generations for your children and grandchildren, it makes sense to put them in these structures that provide that extra protection that's been tested time and time again and has withstood better than really anything out there in terms of protecting your assets for the future.
Yeah, and I think you kind of hit the key words right there, which is who Dr. White and myself are. We're looking to preserve generational wealth, right? We consider ourselves generational wealth strategists, right? We are individuals that look to reduce as much tax exposure and liability for doctors and high net worth clients as much as possible, right? When it comes to estate planning, time and time again, it's what can I gift? How much can I give to charity? What goes out of my estate? When I sell my business or when I sell off a piece of land, how can I be tax efficient with that? What strategies do I need to do now than later so that I can reduce my exposure? And when it comes to that, again, going back to the theme of it's not too late, having the conversation now is better than not having the conversation at all. We assume that everybody that falls into this estate tax threshold has worked with financial advisors, has worked with insurance consultants, and has some form of life insurance or disability insurance already, right? We would be naive to think that they don't. But what we can say is that for those individuals specifically, if these are things that you have not implemented, if you haven't done any sort of generational life insurance planning for your kids or your grandkids, if you are unfamiliar with the difference between whole life and universal life, depending on your age, and how can that fit into my estate planning, these are the questions that you should be asking yourself today, because it's extremely important that not just life insurance, but you're picking and choosing the right life insurance product for what your financial situation, yes, looks like right now, but most importantly is going to look like in the future, which has to do a lot with how your financials lie.
And that's why we always recommend, just like Matt said, it's never too late, but it's also never too early. And so if you are, if you're a practice owner, you're opening more practices, you might think, well, this conversation is maybe not for me right now. That's okay. We're happy to talk to you and actually look at what your trajectory is, because more than likely, if you're in your 30s or 40s right now and you're on that growth path, you will absolutely encounter those issues. By the way, that exemption that Matt mentioned of 26 or 13 million, the reality is where we see things going is that's probably going to be reduced, because that's always kind of a target, politically, to try to get it down in order to generate more tax revenue for the IRS and the budget. And so it's very likely that a lot of you that are listening here that are not in those brackets yet in terms of net worth are going to end up being there, or at the very least are going to be in the brackets that are going to be now lower in, let's say, 40 years from now when those exemptions go down.
Yeah, and it's really hard to tell, and that's a great point, Dr. White, is we don't know what the exemptions look like. It is unfortunately very politically dependent. And, it's set to sunset at the end of 2024, or 2026, and we just don't know, right? Will it be cut in half? Will it remain the same? It's going to have to go through, a bunch of, legal work in the U.S. government. But, I like to make this joke, like, you could be the person that has, the 26 million threshold and your assets are 20 million and you're good. You could also be, the person that the exempt threshold gets reduced to 5 million 30 years from now, and your entire portfolio is basically exposed. We really don't know, right? I always say the luckiest man in the world is George Steinbrenner. If you don't know who that is, was the owner of the New York Yankees, billionaire, multi-billionaire, right? He died the 1 year there was no estate tax threshold. It was completely eliminated, meaning there was no estate tax that year. He just so happened to die that year. Seems pretty suspicious, but
nonetheless,
right? But nonetheless, what we're getting at is it's an uncertainty. It's an unknown. So as Dr. White said, if you're not at 26 million right now, it's okay. If you're that young professional that needs to understand, does gifting shares make sense for me at this time to my kids? Does creating proper wills and trusts with an estate attorney and working with a proper insurance advisor like myself and Dr. White make sense for me? Have I not done that yet? Maybe should I have an initial conversation? Matt, you're right. Maybe the estate, threshold is going to be 10 million. Shoot, I don't know. I got a plan for this. But if you're somebody that's starting to become a high income earner, if you're somebody that's, a little bit more entrepreneurial, you have, you've taken on, some projects, some ventures, things like that. That's the type of individuals that we see, coming to have this type of planning being done. But again, estate planning is for everybody. Everybody should have wills and trusts, especially if you have kids, especially if you're married, right? We're all going to be receiving some sort of inheritance, whether it's zero or multiple millions or billions, right? Everybody receives something. All of that requires planning. So what what Dr. White and I recommend is at least have the conversation about estate planning. There are, of course, higher level things that we can talk about depending on your net worth. But at the very least, I'm sure there's something that we would be able to advise you on that would make sense for you today.
And lastly, for those of you that are involved in charitable giving, which a lot of my colleagues are, that's another part of estate planning, because a lot of us want to leave something behind, not just for the generational wealth, but also to leave behind a legacy to make an impact in our communities. And proper estate planning also takes that into consideration to make it tax advantaged, but also to make sure that your estate follows your wishes and continues on the legacy of charitable giving that you've established.
Absolutely. And, ironically, and not to preach life insurance again, Dr. White, but imagine providing a life insurance policy, a permanent life insurance policy to a charity of your choice, and you pay for 10 years and you're done, or 15 years you're done, or you pay until, you're 100 because you want to keep giving every year. The proceeds from that policy are going to be a lot bigger than saying, hey, here's a $100,000 check. Go do what you want with it. Right? There's a lot more impact that you can have. Plus, you're able to actually gift those shares out of your estate depending on your net worth too. So, there's a lot of things that can be done from a charitable perspective as well that we find very pertinent to our clients too.
Yeah, makes sense.
Yeah, anything else, Dr. White?
I think we've got estate planning covered. We welcome you to come in, talk to us, and see what the proper estate planning strategies are for you. We're looking forward to helping you.
All right, thanks so much.
Thank you.